All right, let's dive in. We're tracking a massive power shift in the markets. People are calling it the Great Rotation. And honestly, you've got to understand what's happening here if you want to know what comes next.
So let's start with a bit of a puzzle. For months, big tech has just been unstoppable, right? Record earnings, incredible performance. They've been the undisputed kings. But now, that momentum is stalling. These tech darlings are suddenly showing some serious weakness, and it's got a lot of people scratching their heads and asking, what is really going on here?
Well, what we're seeing is a classic changing of the guard. The old leaders, the tech titans like NVIDIA and Microsoft, plus the consumer companies that do great when everyone's spending, they're losing steam. And at the exact same time, a new guard of what you might call old economy sectors, energy, pharma, utilities, they're surging ahead.
Now, this shift isn't random. Not at all. It's a very deliberate rotation. And our first big clue comes from simply following the money.
And listen, this isn't just a gut feeling. It's a totally measurable shift. The data from these quantitative models, it's crystal clear. You can see institutional money flowing out of those heavyweight sectors like tech and consumer cyclicals and flowing into these areas with strong positive trends like energy and utilities.
So the key takeaway here is actually pretty simple. The market has new leaders. The bull market isn't necessarily over, It's just that the leadership baton is being passed. Think of it as a handover, not a crash.
But this sector shift, it's really just a symptom. It's part of a much larger and, honestly, a much more predictable pattern, the market cycle.
Markets never move in a straight line forever. They move in waves or cycles. And just like having a map, understanding which phase of the cycle we're in right now can tell us a whole lot about the terrain that might be just around the corner.
So, where are we on that map? Well, all the evidence, from the types of sectors that are leading to how key assets are behaving, it all points to one conclusion. We're in a mature, late cycle phase. In technical terms, this is what's known as the back end of the cycle, a period that's famous for exactly this kind of rotational behavior.
And ignoring these signs, well, that's one of the biggest mistakes an investor can make. It's like you're driving, so confident in the straight road you've been on that you only look in the rearview mirror, totally oblivious to the sharp curve that's right in front of you.
And get this rotation isn't just happening between sectors, it's going global. This geographic power shift, it's our third major clue.
For the first time since the whole 2020 recovery kicked off, U.S. economic momentum is actually slowing down compared to the rest of the world. Europe is kind of holding steady in emerging markets. They're starting to accelerate. This is a classic late cycle dynamic playing out on a global scale. And the flow of capital totally confirms this picture. We're seeing big money rotate out of the U.S. and into markets that are way more sensitive to the global economic cycle. We're talking places like Japan, the UK, and a bunch of emerging markets. The money is definitely on the move. Okay, so let's put the pieces together. We've got a sector rotation, we've got a geographic rotation, both are screaming late cycle environment. So let's connect the dots and see what this means for some key assets like gold, bonds, and energy. First up, let's talk about bonds. Over in Europe, the situation is, well, it's pretty stark. When you actually factor in inflation, the real return you're getting on long-term government bonds is practically zero. Yep, all that value that was created during the last crisis, it has been completely drained away. And at the exact same moment, gold is hitting all-time highs. That's a critical signal. In this kind of environment, gold isn't just a commodity, it's the financial system's pressure valve. That record high price is telling us there is an enormous amount of unseen pressure building up right under the surface.
And that brings us back to energy, which is just absolutely fascinating right now. Why? Because it's playing two different games at the same time. On the one hand, yeah, it's a classic late cycle performer, a great hedge against inflation. But on the other hand, it is the indispensable fuel for the entire AI revolution. It's what's needed to power those massive data centers that are the backbone of all this new tech.
This combination, a late cycle rotation with all this pressure building, it isn't unprecedented. In fact, history might just offer us a roadmap for what could come next. Let's rewind back to 1998. The setup was remarkably similar. The year started off strong, driven by these same rotational themes. Then, bang, mid-year, a crisis at a huge hedge fund triggers this sudden, deep correction. But here's the crazy part. That pullback didn't end the bull market. No, instead it actually became the launchpad for the final, wildly speculative dot-com bubble of '99 and 2000. But this historical parallel comes with a really crucial warning. Statistically speaking, markets in this exact phase of the cycle, they almost always experience a significant correction of 10% or more from their highs. And so far in this cycle, we haven't seen anything close to that.
So what does this all mean for you? Well, first, just recognize the shift is real. Market leadership has changed. Second, start looking beyond just tech for new opportunities. Third, be aware that we're in a mature cycle. That means you need to be flexible. And finally, be prepared for some volatility, because history suggests a sharp pullback is a very real possibility.
You know, right now, this rotation, it's all unfolding with this incredible logic and harmony. The big money is moving in a really predictable, structured way. And that leads us to a final, provocative question to think about. In the world of finance, when does harmony ever last? Thanks for joining me for this explainer.